What's going on, everybody? Welcome back for part 3 of my tutorial series on the system. So in the first 2 videos that I made, we talked about some basic concepts that hopefully helped you to understand how the system works. Now I'm going to dive deeper into how to actually trade using the system. So this video is going to be the basic concepts that I have found have given me success while using the system in my trading. In future videos, I'm gonna get into the specifics about trading options using the system, trading common stock using the system, and trading futures using the system. Again, in this video, I'm just gonna outline basic rules and strategies that I have found that have given me success trading using the system. Before we get started, if you guys could give me a follow on Twitter at @BoldHouseTrades. I recently changed my handle, so make sure that you're following me. I talk through my trading intraday and give tips on how I use the system in real time, so I think you guys would really enjoy following me. Now let's get into the video. The first concept that I want to cover is where and how to enter in anticipation of a buy or sell signal. Now there's a very key word in there. That's anticipation. So we're anticipating the cross of the moving averages. A very common question that I get is, aren't you late to the move if you wait for the moving averages? Isn't the system lagging? Why is the system telling me to get short when we've already gotten this massive sell-off? Why is the system telling me to get long when we've already gotten this massive rip? Again, we're trading in anticipation of the moving averages crossing. So when I look to enter a trade, my main focus is on that 50 SMA. Now for this example, just so we can get this concept down, I'm only going to be using the 30-minute chart. We're not talking about the hourly chart right now. So what makes most sense to me is to enter as close as I can to that 50 SMA because that gives me a strong risk versus reward. Now, what do I mean by that? Let's take this example. We break down below the 50 SMA, okay? So now, if I wait for this sell signal, look at how far I am now from the 50 SMA. Now, why is the 50 SMA important? Let's think back to video number 1 where I touched on key concepts. We know that above the 50 SMA, bulls are in control. Below the 50 SMA, bears are in control. So if I look for a short on the break below the 50 SMA, does it not make sense to have a stop loss just above the 50 SMA, knowing that the trade idea would be wrong if we recover it, right? If I'm anticipating that bears are going to start to gain control, I want my stop loss to be above that 50 SMA because if we come down, it's a fake and we break back above, then that's okay. I know not to be short there because I know that it's likely that it was a fake down and that bulls are still in control. Now, if I'm looking to short on the actual cross and I'm down here, we might get a bounce, okay? We might get a bounce all the way up here and it stops me out of the trade. But below the 50 SMA, bears are still in control. So what could happen? This is a perfect example right here. Let's say you go short here. We get this bounce. You get stopped out. But look what happens. We curl lower because the bears were still in control, but you had to get stopped out of the trade, okay? So the idea was right, but you did not enter at a good spot with good risk versus reward. So again, very important for me to enter as close as I can to the 50 SMA because what I can do here is I can get short, have a stop just above the 50 SMA. If I get stopped out, fine. The idea was wrong. If I don't, the trade is going to play out pretty nicely. Same goes for when trading long. I want to get in close to this 50 SMA because if we break back down below, that's fine. Bears regain control, time for me to get out of the trade. And if not, I could play the nice run up. Now, if I were to enter here, same story. When we get this crossover, what happens if we pull back 15 points at the 15 SMA, but I'm freaking out, I'm losing money, it hits my stop loss? Well, we could come down to that 50 SMA but continue higher because we know that above the 50 SMA, bulls are still in control. So very important to create a strong risk reward for yourself. And I have found that to be closest to the 50 SMA as possible. Now, the next common question, where to take profits. There are a million different factors that can come into play here, but I'm going to introduce 2 key concepts that I feel are very important. Number 1 is we have the 100 points extended from the 50 SMA rule. We can consider this to be oversold or overbought territory. So on this sell-off, we're selling off. The bears are in control. Look at where we bottomed. So SPX was at 38.85-ish. The 50 SMA was at 38.70-ish. So in that range from 80 to 100 points extended from the 50 SMA, that's when I'm looking, if I'm still in that trade, if I was able to manage to ride this whole move lower, I'm going to be looking to scale out or just completely exit the trade. The reason for that is because we know that 100 points extended from that 50 SMA to the downside means we're entering oversold territory. The same works on the upside. Here at the top of this move, 40.35-ish, 40.40 we'll call it, the 50 SMA was around 39.50. So 90 points extended from the 50 SMA to the upside. As you approach that 100 points overextended, you got to start to ask yourself, okay, I think we might be overbought. And look what happens. The market was due to cool off. Now, the next concept that I want to introduce is the breach of the 10 SMA. We know from the earlier videos that the 10 SMA is our visual representation of momentum in the market. We can use this to our advantage when we're looking to take profits. If the 10 SMA is coming down hard, we can see how there's that clear momentum. We curl off of the 10 SMA, but look what happens when it is breached for the first time. The market starts to chop and eventually reversed. To the long side, we see strong momentum, lots of buyers, boom, 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 ripping. We get up to that overbought territory. That could have been your first signal to take profits, around 100 points extended from the 50 SMA. If not, you know that momentum is starting to be lost when you get a breach of the 10 SMA. It was in a strong uptrend, then it starts to flatten out. We break below, and look what happens. Chop, 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 an eventual reversal. Now, those two concepts work phenomenal in a trending market. There are times in the market where we see beautiful trend. There are other times where things are choppier. So having your levels drawn out on the chart, your key support and resistance will give you better insight as to where the market may bounce, where it may reverse, and those could also be take profit targets. Now let's talk about incorporating the 1 hour chart. So on top here, we have the 30-minute chart. On the bottom, we have the 1 hour chart. A common question I get is, why did you enter that trade if the two charts weren't necessarily telling the same story? Right here is a perfect example of where or how that can happen. We get the sell-off, we get the break below the 50 SMA on the 30-minute chart, followed by the sell signal, but we still hadn't breached the 1 hour 50 SMA. So what do? This is a lesson in measuring and understanding risk versus reward. So right here, we were sitting at about 39.80 SPX, okay? The 50 SMA on the 1 hour chart was at 39.48. So that's about 30 points down to the 1 hour 50 SMA. To me, if I can keep a 10-ish point stop, and we will talk about futures trading in a future video, then I know I still have strong risk to reward. I have about a 10-point risk and a 30-point potential profit down to that 1 hour 50 SMA. So I can take the trade, I can grab my short, and I can scale some out down at that 1 hour 50 SMA. And I remember taking this trade, and that's exactly what I did. So I'll enter the short when we break the 50 SMA on the 30-minute chart. When we get down to the 1 hour 50 SMA, I'll take some profits because I don't know what's going to happen there. I know that that's a strong level of support. We might bounce. I might get stopped on the rest at entry. We might break through, and it might give me an awesome trade. In this particular example, that's what happened. We got the breach of the 50 SMA, and it continued. Now, if you had waited for the two charts to tell the same story, you would have been shorting all the way down here. So you would have missed out on 30 points. So it's up to you as the trader to decide, is the risk versus reward strong here? There are other scenarios where the risk versus reward might not be all that, and it might actually keep you out of the trade. Here's a perfect example. We get the break below the 50 SMA on the 30-minute chart. On this candle close, we're sitting at about 40.26 SPX. Now, the 50 SMA on the 1 hour chart was at 40.15. So you've got about 10 points of reward there if you want to take that short. Why not just wait, give it the 10 points, wait for the confirmation below the 50 SMA, and then get short? Had you taken this short, you would have gotten cut. So you had about 10 points of risk. You had 10 points of reward down to that 50 SMA on the 1 hour chart. So that's only a 1-to-1 risk versus reward. And in this particular case, the 50 SMA on the 1 hour chart held, it bounced its support, and the market traded higher. It would have been either a break even or a losing trade. Another common question that I get is, do you wait for a candle close below or above the 50 SMA before taking your trade? Now, in a perfect world, you get something that looks like this. The close below the 50 SMA, you come back and retest it, and then you sell off. Again, perfect world scenario. There are other cases where you get something like this. You get the close above the 50 SMA and the market just rockets, or the market just sells off hard. And had you waited for the back test of the 50 SMA, you would have missed the trade completely. So in general, I'd say a good rule of thumb is waiting for the candle to close either below or above the 50 SMA. But there are a lot of things that come into play here. Going back to that risk versus reward, had you waited for this candle to close above the 50 SMA, you would have already been about 15, 20 points extended from that 50 SMA, versus if you can spot that momentum in the market, having your levels drawn out, seeing that we're breaching certain levels, you could have taken that long closer to the 50 SMA. In these scenarios, it's really going to be up to you. How has the market been trading? Has it been a choppy market? Are you afraid that there's going to be a fake breakdown below that 50 SMA? Are the two charts, the 1 hour and the 30-minute, not telling the same story? That's probably a good spot to wait for that confirmation of that candle close. Has this been a trending market with lots of momentum? That might be a good spot to just take that trade as soon as you get a breach of the 50 SMA. Unfortunately, it's not so black and white, and you're going to have to test things out and trade the system yourself to see what works for you in what scenarios. Now, the last thing that I want to talk about is being all cash into a volatility-inducing event. I'm talking CPI, FOMC, anytime Jerome Powell is speaking. The system might be telling us one thing leading up to that particular event. But let's be honest, nobody knows how the market is going to trade, and it's important to manage your risk and protect your capital and not try to predict, but rather react. You cannot blindly follow the system. You have to understand the market environment. If something big is coming up, like an FOMC or a CPI, this chart that I'm showing you guys was from a week where we had both CPI and FOMC. You could see how violent these moves were. Rips higher, breaks lower. You have to be prepared for that, and you have to be able to manage your capital. Blindly following the system because you're trading above the 50 SMA going into a volatility-inducing event, or below the 50 SMA going into a volatility-inducing event, is a very easy way to lose money. Be smart and wait for the system to tell you what to do. Do not try to anticipate what will happen after these events. I hope you guys enjoyed the video. If you did, please do me a massive favor and like and subscribe to the channel. That helps us out a ton. Also, for those of you that are unaware, I trade live all day, every day in the Kane Capital Discord. You can go to kane-capital.com or hit the link in the description to trade with me. Looking forward to seeing you guys, and looking forward to seeing you guys on the next video.